All right, I want to look at the put analysis for the week. This is something we really haven't done very much. Usually do it after the fact. Uh, so we're doing this on Christmas. It's Friday, so we got Saturday and Sunday to look at these. Um, this is, of course, if you're not in these positions, it will change. I own 30, 3565 of TQQQ right now. So I'll probably be selling calls against it. Depends on what happens in the morning. If the futures are up Monday morning or not. But if you didn't have a position and you wanted to sell the puts, which is what I start out at. If it gets put to me, which it did at 165, and I think it's going to go up, which it has, it's went up to almost 175, 174.65 is what it's trading at now. Then, depending on whether I think the market's going to go up or not, I might sell the calls against it, which I did twice. I sold the 170s, I once sold the 175s. We've done really good in December. So, um, right now I'm at 54 point something percent um, for the year, and I'm looking to juice it a little bit with the calls. But what I want to look at here is if you don't have a position and you wanted to sell puts, what kind of analysis do you go through? So this is what I do. So I just go to Yahoo and I just cut and paste it into a Excel worksheet, spreadsheet, and then I took the bid and the ask and I cut it into and came up with the figure in column M. And column M is just the bid and the ask divided by 2. So just to get a midpoint of the bid and the ask, which would be a fair number that you could possibly get for a premium. And then what I do is I divide that by the strike price. So, and the reason I do that is that's how much money you have to um, to be able to cover this if you're selling puts against it in case the stock gets put to you. So that's what they mean by put to you, if the stock gets put to you. So what happens here, let's look at the 165s. So it's trading at 174.65. If you sold the 165s, you get $1.71 essentially when you sell it. Okay, the $1.71 is the premium. You get that regardless. And let's say, in my case, I could sell 3,400 because I have 3,400 that's option that I could sell options against of the 3565 that I have. If I decide to do that, 1.71 divided by 165 is 1.04%. And if you times 1.71 times 3,400, you get 5,814. So what happens here? You get 1% on your money for the week. And then what's the worst case scenario? So if you look over in column P, I have the worst case scenario here. The worst case scenario is the stock is down more than 165 and it gets put to you at 165. Now, you would have got $1.71, and so your effective price would be 163.29. If the stock ended up, if the ETF TQQQ ended up at 163.29, below that, you would be losing money. If it's above that, you'd be making money. If it's above 165, you'd make, the best case scenario is you'd make the 1.04% for the week, and nothing would happen because the stock ended up higher. Same thing at the 170s. The 170s, you get a little bit more premium, so you're getting 1.67%. And with my 3,400 shares, I could make about $9,000, $96.73 for the week. Worst case scenario is it gets put to me, the market goes down, I'd have to buy it at 167.15. Best case scenario, it's over 170, and I I make $1.67. Now, in those two scenarios, what would happen? Well, you bought it lower. So if you believe in TQQQ, which I do, I think it would go back up. So there could be some event that would make it go down, but the bias for the Christmas rally, the Santa rally, for the last week of the year is that the market will go up. So that's the bias. Now, you could have your own opinion. You could overthink this. You could say, wow, the stock market's up really high. I hear people say that a lot, but the truth is, these triples are always going to be at highs. If you look over the last 10 years, they've hit new highs after new highs after new highs after new highs. So at any time during that time, you could say, oh, well, this is at new highs. I don't want to buy it there. That's a really flawed logic, because stocks have to be at all-time highs to hit new highs. So that's the truth. Now, if you think Biden coming in, he's going to tank the market, we're going to have a recession, if this is your scenario, then there you go. I mean, or if you think there's an event coming up at the end of the year. But for this scenario, I think that the market's going to go up. That's my bias. I think the market's going to be, I think TQQQ is probably likely going to be at 180 by the end of the week. That's my guess. So that's my bias right there. Could be wrong. Would I trade it up to 180? I might. But the other thing is that what we need to look at is that this is also the last week of the year. So don't want to do anything too crazy. I really kind of don't want to hold a position going into the new year, because I want to close out and get a clean number just for my yield for the year. I can do it on a spreadsheet, and that's fine. So there you go. So those are two, pretty safe bets. If you're trying to make income, which some people might be doing, is trying to make income, then 1% for the week is fantastic. So you might look going down even further than that. You might even go down to 150 and make 0.25%. Because if you do that every week, remember these are weeklies, then that ends up being quite a bit of money. And then worst case scenario, you bought it 25 points lower, and you still make what would be 52 times a quarter. So you're still making a good rate. And worst case scenario, you're buying the stock or the ETF much lower. Now, what would I do? Since my bias, since I'm not a scaredy cat, which I'm not, which sometimes can get you in trouble, and my bias is that I think that it might trade around 180 at the end of the week. I could be wrong. It might trade down. It might trade even. But my thought right now is that, and I haven't seen the futures, whether they're up or down Monday. That's going to affect your thought process. But right now, my thought is it might trade around 180. So if it trades around 180, then I would be willing to sell the puts a little higher than what they are now. And that would be a point higher. And so I think one of the best bets going into the end of the year, and I might pay a little bit safer other times, but I really think there's a strong bias for the market to go up in the last week of the year, is I might sell the puts for the 176 and get the 510. Now, this is a lot more risky than doing the 165s, obviously, because it's a 10-point difference. But that would be essentially committing to something that's $1.35 higher. So your effective is going to be you'd have to if you got put to you. If it was actually lower than 176, you'd have to buy it at 176. But since you got 510, effectively you'd be buying it at 170.90. So it's trading at 174.65. Could you commit Monday morning to buying it at 170.90 at the end of the week when it's trading at 174.65 at the beginning of the week? I would make that commitment. So I think one of the best, being that right now I have a bias that I think that the ETF will be higher, and I think it will be, my guess is it might trade up to 180. We've got 4 days of trading. That would be, a little over a point a day. Or you could have one really good day. The rest of the day's flat. 3 or 4 points is not definitely not unheard of, especially if you've got a bias to the upside. So that would be 2.9% for the week. So 2.9% for the week times that times 52, you're going to get like 150%. So that would be really great if you got that. Now, what happens if the stock falters? Let's say it goes down to 170. You'd have to buy it at 165. Your cost is 170.90, so you lost 90 cents. Of course, it could go down further than that. These are triples, so they can be down 10 points. It can be down 20 points. Something really bad happened. It was a bombing or whatever. So that could happen. But this is the analysis that I go through. So really, you don't need to do the spreadsheet. You don't need to look at all of them. Sometimes I do this because I want to look at how much risk do I want to take, and I really do it if there's a choppy market, and I'm really kind of weary about the market, and I want to see, if I bought it like at the money, at the money would be essentially 175 now. You're at the money since we're at 164.65. So if you look at the money, you look at 174, 175, you can make still, right at 2.5%. So 2.5% for the week, that's incredibly good. Incredibly good. If you look at the 170s, effectively you'd be buying at 167.15 if it went down lower. Still 1.67%. You're looking at 70 some percent for the year if you did this every week. And so this is the beauty of selling puts. Now, what can you do with selling puts that's also good? Let's say you just want to buy the security. You really want to buy the security. That's what you want to do. And you'd like to hold the security. Selling puts against it to essentially buy the security is also a way to get in cheaper. And so if you want to do that, then you could go up to the 180s and you say, okay, I want to buy it this week, but I'd like to get a discount. So you could get a discount by buying it at 180, and you'd get a 755 premium, and you essentially be buying it for a little bit cheaper. So, so you get a couple of point discount. So that's a way to enter it, getting it a little bit cheaper. These low percentages add up over time. They really do. And if you stay on top of it, and if you trade every week, trading's essentially free now, and so trading's a lot better than paying $10 in, $10 out. So each trade's going to cost you $20 if you did it every every week or just once a week. It would cost you $1,000. Those costs are gone now with everybody essentially trading essentially being free or almost free. And so this is the kind of analysis that I go through. So this is analysis with puts. I'm going to turn around and I'm going to do analysis on calls because I actually own TQQQ now. Like I said, I've got 3565 of it, of 3400 of it. I have where I could write calls against it. So, but I really like selling puts to get in cheaper. And why wouldn't you just buy the common? You can buy the common. I mean, if you look at the chart for the common, it's great. It's spectacular. I think if you sell the puts, or if you sell calls against it, if you own it, then you're lowering your risk. And don't underestimate lowering your risk. Even if your yield goes down a little bit, if you lower your risk over time, that helps you out. Especially if we have, something that, a couple times a year the market really, tanks or whatever. So you got in lower, you're not losing as much. It really depends on your risk strategy and your different strategies. But when we're looking at these triples and we're looking at making 1% or more a week, then we're looking at making over 50% for the year. So there you go. That's my analysis on selling puts. So my best buy would be for this week anyway, would to be buy the 156 at 510. We can do another video at the end of the week on New Year's and see how that best buy came in. Of course, if we look at the futures and the futures are way down in the morning, this may not be a strategy you'd want to do. I mean, because it wouldn't make sense then. So if it's up, then you'd want to grab it as soon as you can. So there you go.